Let's talk about a word you've probably heard a million times in finance: diversification. It's one of those terms that gets thrown around so much, it kind of starts to lose its meaning. Well, today, we're going to cut right through all that noise and get to what it really means to build a portfolio that's truly strong. And to do that, let's kick things off with a little thought experiment about dessert. Yeah, dessert. If you wanted a genuinely diverse menu, where would you go? Baskin-Robbins with its famous 31 flavors of ice cream? Or a giant supermarket? How you answer that is pretty much the key to understanding one of the biggest mistakes investors make. You see, the real problem here is that the word diversification is used so loosely, it's almost powerless. You hear it from pros, you hear it from amateurs, and that confusion, that ambiguity, can lead to some really big misunderstandings about how to handle risk. And look, this isn't just some minor complaint. As the author of our source material points out, it is, well, maddening. It creates this kind of fog that actually makes it harder for regular people to build portfolios that can actually stand up to tough times. So let's break down the biggest misunderstanding of them all. It's this illusion of safety, this idea that just because you own a whole bunch of different stuff, your portfolio is automatically secure. For instance, you might hear someone say they're diversified because they own both Pepsi and Coca-Cola stock, or maybe they have shares in United and Delta. I mean, on the surface, that feels like you're spreading your bets, right? But take a step back. Are those companies really all that different from each other? Let's look at a more complex example. This is Paul Merriman's ultimate buy and hold strategy. It's a portfolio made up of 10 different stock ETFs, covering all sorts of markets and sectors. Now you look at that, 10 different funds, and you think, wow, that is diversification. But then you see this number, 0.91. What is that? That's the portfolio's beta. All you need to know is that it's basically a score of how much it moves in sync with the overall stock market. A score of 1 means it's a perfect mirror. So a beta of 0.91 tells us that even with 10 different funds, this portfolio behaves almost exactly like the S&P 500. It's just more flavors of the same ice cream. And that brings us right back to our dessert analogy. What that portfolio has isn't really diversification. What it has is variety. It's Baskin-Robbins, 31 flavors. So let's put a pin in that. Let's define it. Variety is just having an assortment of assets that are, more often than not, in the same bucket. You've got French vanilla, chocolate, Rocky Road. Sure, they're all different flavors, but at the end of the day, they're all just ice cream, and they're all going to melt in the sun. Here's a perfect real-world example of that. Investors love to buy international stocks, thinking they're diversifying. But just look at this data. Since 2007, U.S. stocks and European stocks have a correlation of 0.89. That means they move together almost 90% of the time. When the U.S. market gets a cold, you can bet the European market is about to sneeze. It feels different, but it's really just more variety. Now, let me be super clear. Variety is not a bad thing. In fact, it's a really important first step. It protects you from the risk of one single company going belly up or one specific industry having a terrible year. But it's just that. It's the first step. It is absolutely not the whole story. Okay, so if variety is Baskin-Robbins, what's the next, much more powerful idea? Well, if variety is the ice cream shop, then true diversification is the entire supermarket aisle. This is what we're going to call dissimilarity. Dissimilarity is all about combining things that act differently because they're driven by totally different economic risks. One asset might do great when inflation is high, while another does well when inflation is low. One loves economic growth, the other provides a safe haven when things slow down. This is where you find real, lasting portfolio resilience. Think about that supermarket again. When you want dessert, you don't just have 31 flavors of ice cream. You could grab a birthday cake, a dozen donuts, a fresh fruit salad, or hey, you could buy flour and sugar and eggs and make something completely different yourself. These are fundamentally different choices that don't all react to the hot sun in the same way. So here it is, the bottom line. Variety is just having many different versions of the same thing, like a bunch of different stock funds. Dissimilarity is owning fundamentally different things, like stocks and long-term bonds, that have a history of not moving together. Okay, so we've got our two big ideas, variety and dissimilarity. But this isn't just some lecture on vocabulary. Understanding this difference is absolutely crucial for building a portfolio that can actually protect you when you need it most. Let's talk about why this really matters. It really boils down to a pretty simple two-step path. Step 1, you absolutely start with variety. You own a broad mix of stocks, US and international, to get rid of that single company risk. That's your foundation, but, and this is the big one, you cannot stop there. Step 2 is where the real work is done. You add dissimilarity. You combine those stocks with other things like long-term treasury bonds that have proven they zig when stocks sag. And that right there is the single most important takeaway. The real magic, the secret sauce for a portfolio that can handle whatever the economy throws at it, comes from combining truly dissimilar assets, not just from collecting a bunch of slightly different versions of the same thing. All of this leaves us with one final, kind of provocative thought. Maybe the word diversification is just broken. To be clear, to really get to the heart of what builds resilient portfolios, maybe we should stop saying diversification and start talking about asset dissimilarity. What do you think?